The average investor made just 2.9% a year in the 2 decades to 2020, and most investors don't even know it. They miss this silent killer in their stocks and have no idea why their portfolio goes nowhere. In this video, I'll show you the biggest thing holding most investors back from higher returns. I'll explain the difference between short-term trading and long-term investing, and then reveal 3 strategies to make money no matter what type of investing you do. We're talking stock trading versus investing today on Let's Talk Money. Hey Voti Nation, Joseph Hogue here with the Let's Talk Money channel, and I gotta send that special shout out to all you out there in the nation. Thank you for spending a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. Nation, according to data from the New York Stock Exchange, the average investor holds their stocks for just 5 months. That's a new all-time low, down from a holding period of 8 months as recently as 2019 and a high of 8 years back in the 60s. And as a result of this short-term trading mentality, the average investor has earned just 2.9% annually over the last 20 years. JP Morgan studied investment returns and found the average investor made just 2.9% a year. That's versus a 7.5% annual return on stocks in the S&P 500 and even below the safety of a bond portfolio that returned almost 5% a year. And now if those numbers don't scare you, think about this. Investing just $500 a month and getting that market return of 7.5% would get you to almost $260,000 in 20 years. But if you made that mistake that most investors do and only get that 2.9% return, you'd be left with just $159,000 over that period, a difference of almost exactly $100,000. And it's not because investors are trading in and out of stocks, it's because they're doing it thinking they're long-term investors. Let me say that again because it is the single biggest message of this video, the one thing I want you to remember. Nation, long-term investors will make money. Short-term investors and stock market traders will make money. The people that will not make money are the stock traders that think they are long-term investors. The average investor costs themselves over $100,000 because they don't know what type of investor they are. So I want to start off explaining the difference, showing you what it means to be a short-term trader versus a long-term investor, and how to know when you're trading instead of investing. I'll then show you how to pick the strategy right for you, and then 3 ways to invest. It's part of a special workshop I put together with Thomas Cargo on stock trading and technical analysis. 35 videos and more than 4 hours of instruction on the stock signals you need to know. You'll learn everything from trading time frames to using stock charts and finding the trends that are going to send stocks higher. You'll be able to download a trade journal template along with trade cheat sheets and lots of other bonus material. Now we just launched that workshop last month and we're offering a special 35% discount, more than $150 off to everyone here in the community. So check out the link I'll leave in the description below. Here though, I want to start off with the difference between short-term stock trading and long-term investing because it's not as obvious as it might seem. Investors may say they're in the stock for the long term, but their actions of buying and selling paint an entirely different picture, and being successful here means using an entirely different set of tools. Long-term investing is about analyzing the fundamentals of a company, looking at the industry and the competitive landscape, as well as the financials like sales growth, profitability, and cash flow. You're buying stocks of companies to get an ownership stake in the earnings because you think those are going to be higher over the next 3 years or more. Now, short-term stock trading, on the other hand, has much less to do with those fundamentals of the company and more to do with swings in the stock price itself. Here, you're focused on patterns in the stock price over the last month or even down to the hour and trying to get a sense of that investor sentiment in the shares. Here again, that last piece is hugely important, so I want to repeat it. With short-term stock trading, where you might only hold a stock for maybe a day or a month or even up to a year, the single biggest factor in the price is that investor sentiment. You can have a stock with strong long-term growth, but if investors are short-term negative, then any news is going to be viewed through that negativity and the shares will struggle. And this is why it is so important to know whether you are a long-term investor or a short-term trader in a stock. Long-term investors need to have that conviction in their analysis for those fundamentals, that even if a short-term sentiment is negative and the shares seem to go nowhere but down, that longer-term growth picture in the earnings will win out. Short-term traders, on the other hand, need to be watching the patterns in a stock price and what it says about that investor sentiment. The problem here is that a lot of investors say they're in it for the long term. They find the stock with a strong growth and those long-term fundamentals, But then a negative sentiment pushes the stock price lower and they just get spooked. They flip-flop and sell out of the shares within a month or two, taking a loss and thinking that their analysis on the company was wrong. And of course, the real kick in the ass here is that their long-term analysis was probably right, but they just didn't give the company time to prove it. They sell at that loss, only to see the stock jump higher over the next couple of years. There is nothing wrong with either of these two strategies, stock trading or long-term investing. In fact, the best strategy for many investors may be doing a little bit of both, and let me explain why. Now, the data is pretty clear that long-term investors, a strategy of buy and hold, tends to do better in returns. Even if you're not Warren Buffett at picking those long-term stocks, you're going to get closer to that 7.5% market return versus the 2.9% average return most investors earn. And here I'd probably add also that short-term investing is more difficult as well. Besides that constant analysis of the stock patterns, you're dealing with a lot of emotions and investor behaviors that can get in your way. But the problem is, one unavoidable force gets in the way of investors enjoying that long-term investing strategy: themselves. Some investors just have trouble doing nothing while a stock price drops, no matter how strong their conviction in that long-term upside. Other investors, they just like the thrill of watching prices and booking those quick returns. If they can't buy or sell something every week, they get itchier than a crackhead on payday. And that's why you see the average investor getting just 2.9% returns, because they start off as a long-term investor, but end up buying and selling like a stock trader. They've used the wrong tools to analyze a stock and just end up losing money. Now, if that sounds like you, not the crackhead part, but the itch to watch your stocks constantly and the nervousness around those short-term price changes, then the solution may be to dedicate at least a part of your portfolio to stock trading. Maybe you have 70 or 80% of your portfolio in those long-term investments, stocks that you pick using that fundamental analysis and commit to holding for years. Then to scratch that itch, to take your mind off obsessively watching those long-term stocks, you use the other 20% of your portfolio for those shorter-term trading. With this part of your portfolio, you use those short-term indicators and the signals to trade in and out of stocks for those quick profits. Now, to totally screw with your mind, I want to highlight the difference between two types of short-term trading. You thought it was as simple as short-term versus long-term investing, you silly little sloth. Just like the difference between long-term investing and short-term trading means using different tools to pick those stocks, different holding periods in stock trading can also mean a different strategy in your analysis. In day trading, you're buying and selling a stock within the same day. Rarely will a stock trader even hold a position overnight. This is going to be all that technical analysis. Everything in day trading revolves around the chart and patterns in the stock, and usually shorter term patterns at that. You're positioning on a stock to bounce off maybe its 10-day support or to weaken from short-term resistance. Now, a completely different type of stock trading is called swing trading, and this is where you might hold a stock for up to days, weeks, or even as long as a few months. Here, you're still largely trading off that short-term sentiment and the signals that you find in the price chart, but you might also use some of the fundamental analysis as well. And most of the time here, you're looking for stocks where the near-term direction conflicts with that longer-term fundamentals, and you're investing at the inflection points. Now, this might be anticipated news or earnings that are going to swing the stock in the other direction. And just like the difference between stock trading and long-term investing, success using either of these two types of short-term investing depends on knowing which strategy you're using and using the right tools. Get your $150 discount to the Stock Signals course with the link below, or click on the video to the right for a step-by-step to creating a dividend stocks ladder and living off the cash flow. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.